Goldman Sachs BDC beat consensus for its Q2 2026 earnings. I mean, adjusted EPS came in at $0.37, beating that $1.31 estimate.
Yeah, pretty solid beat there.
Right, and revenue hit $83.72 million, edging past the $78.89 million expected. But the forward consensus EPS guidance for next year is looking weaker at $1.07, down from the current $1.15.
Which is a pretty significant drop-off.
Exactly, and the stock reaction was mildly positive, like it popped slightly in extended hours and closed the next trading day up nearly 1% at $9.18, though it's still down about 5% since April.
Right.
So for you listening right now, we are jumping straight into the underlying financials today because we established that headline beat, but the actual GAAP earnings were much, much lower.
Oh, completely different story.
Yeah, like just dual 21 cents per share. So, I mean, what drove this top-line beat, and why does that GAAP EPS look so entirely different?
Well, it's a massive gap. You've got the $3.37 adjusted net investment income, the NII on one side, and then, just 31 cents on the GAAP EPS.
Right.
And the primary drag there, the reason for that gap was just a massive increase in net realized and unrealized investment losses.
Unrealized losses, so markdowns.
Exactly, asset markdowns. For this specific quarter, those losses ballooned to $18.5 million. And, just to put that in perspective, if you look at the exact same quarter a year ago, those losses were at just $5.2 million.
Okay, let's unpack this because, it's like a retail store bragging about record quarterly sales, but completely ignoring the fact that the roof caved in and destroyed half their inventory.
Yeah, that's actually a great way to put it.
Right. Like, if the recurring income from the loans is so strong, why is the capital appreciation, the actual asset value, just suffering so badly?
Well, that's the thing. The NII beat that $1.37. It was partially artificial.
Oh, artificial, how?
So it was heavily aided by this temporary zero incentive fee period. Basically, the external management team waived their performance fees for the quarter.
Wait, really? They just gave up their cut?
Yeah, for now. And because of that, total net expenses dropped pretty significantly. So that temporary tailwind allowed GSBD to provide 119% coverage on their $1.32 base dividend.
Okay, that makes sense.
And they even had enough excess cash to issue a $0.03 supplemental dividend. So if you annualize that out, they're yielding about 12.3% on book value right now.
Which, sounds amazing to an income investor.
It does. But going back to your retail store analogy, the roof is still caving in. Because of those $18.5 million in investment losses, the net asset value, the NAV, slipped 0.9% sequentially.
Ouch.
Yeah, it dropped down to $12.06 per share. So they're handing out these great cash yields, but the underlying asset base is literally shrinking.
Which means we really need to look directly at the credit quality of this portfolio. If the NAV is bleeding, we need to know where the bleeding is coming from.
Exactly. And the risk flags are definitely there. The big one to look at is leverage.
Right, borrower leverage.
Yeah, the weighted average leverage of their portfolio companies has climbed to 6.2 times.
Wait, 6.2 times EBITDA?
Yes, 6.2 times EBITDA.
Wow. So for every $1 of raw cash flow a business makes, they have $6.20 of debt stacked on top.
Right, which indicates a really elevated level of financial stress for these borrowers. There's, basically no margin for error. And because of that stress, non-accruals loans that are no longer paying interest, those rose to 5.0% of the portfolio at amortized cost.
5.0%. That's not negligible.
No, not at all. And if we look at the specific companies in the report, it's a really mixed bag. You have the restructuring of Chase Industries, for example.
Yeah, I saw that in the notes. That one was confusing because they had mixed results with the exact same company, right?
Exactly. GSBD held multiple tranches of debt with them, so they restructured to save the company. One of the senior loans went back to paying interest, so it returned to accrual status.
Okay, good.
But to make the math work, another lower priority loan they had with Chase had to take a back seat. It stopped paying cash interest, meaning that specific loan went onto the non-accrual list.
So they basically sacrificed one loan to save another.
Yeah, that's middle market lending for you.
Yeah.
You also had Thrasio, which was a positive that returned to accrual status.
Right.
But then on the flip side, they had to add Wine.com to the non-accrual list because of just pure financial underperformance.
So with borrower leverage this high, and with these restructurings happening, Fitch Ratings just noted a deteriorating outlook for the whole BDC sector.
Yeah, they did.
And Bank of America recently reaffirmed an underperform rating on GSBD specifically. So I have to ask, is their massive 14.5% market dividend yield actually just a value trap for the retail investor listening right now?
Well, what's fascinating here is that there's a real dual-track debate on Wall Street about this exact question.
Okay, let's hear it.
The bulls look at this and say, hey, 98.6% of this debt is senior secured.
Meaning if the borrower goes under, GSBD is first in line to get paid back.
Exactly. First lien, senior secured. It's a huge defensive cushion. The bulls think that structure will protect the core value.
But the bears obviously don't buy that.
No, the bears and buffets in this camp, they see structural earnings rot from the legacy pre-2022 loan vintages.
Ah, the loans made before interest rates shot up.
Right. Loans underwritten when money was virtually free. Now that rates are high, those older borrowers are suffocating under the interest payments. The bears think those legacy loans will just keep dragging the NAV down.
So if that's the bearish case, management can't just sit around and watch the NAV erode. Co-CEOs David Miller and Vivek Bantwal must be making moves.
They are. They're making some pretty aggressive defensive moves. Post-quarter, they actually successfully deleveraged the balance sheet.
Right, bringing their own debt down.
Yeah, down below their 1.25 times target. At the end of Q2, it was at 1.35x, so that's a solid improvement.
Which they probably had to do to keep the rating agencies from downgrading them.
Absolutely. And they also authorized a $75 million share buyback program.
Which makes perfect sense mathematically. I mean, if the stock is trading at $9.18 and the NAV is $12.06, that's what, roughly a 24% discount?
Exactly. It is highly accretive to buy back shares when they're trading that far below the actual asset value.
You're buying $1 for 76 cents.
Yeah.
Yeah.
But going forward, management is projecting an acceleration in middle market M&A deal signings in the second half of 2026.
Meaning more opportunities to originate new loans.
Yes, and the transactional spreads right now are highly attractive. They're pricing between 475 and 500 basis points over the base rates.
So a 5% premium over base. That's lucrative.
Very. If they can deploy capital into those new loans, they can offset the drag from the 2021 vintage.
So what does this all mean for the bottom line? Because I'm looking at the math here, and there is a huge conflict.
Yeah, the math is tight.
Right. If Wall Street consensus expects next year's EPS to drop to $1.07, but the annualized base dividend costs $1.28, I mean, that creates a 119.6% payout ratio.
It does.
So how long can management sustain that without just cutting the dividend?
Honestly, they can't. Not long term. To avoid cutting that dividend, management must execute flawlessly on their pipeline for the second half of 2026. Flawlessly. They have to rapidly rotate capital out of those struggling legacy assets, even if they take some hits and get it into these higher-yielding new originations.
Before the temporary fee waivers wear off.
Exactly. It's a race against time.
Which brings us to, I think, the biggest unknown for anyone listening and trying to evaluate this stock.
The macro puzzle.
Right, because the BDC sector is benefiting right now from traditional banks pulling back from middle market lending.
Yeah, there's a massive opportunity for GSBD to partner with private equity capital that's just waiting to be deployed.
But, and this is a massive, but 98.9% of GSBD's performing debt bears floating interest rates.
Right.
So what happens if the Federal Reserve actually executes those anticipated rate cuts later in 2026?
That is the trillion-dollar question. If rates drop, the interest GSBD collects drops automatically. That would severely compress their net investment income.
Putting that fragile $1.28 dividend under even more pressure.
Exactly. It's a double-edged sword. You want the borrowers to have some relief on their interest payments so they don't default.
Right, to fix the non-accrual problem.
But if rates fall too much, GSBD doesn't generate enough cash to cover its own payout. It's an incredibly tightrope they're walking right now.
Wow. Yeah, so if you were holding this for that 14.5% yield, you have to be watching the macro rate environment just as closely as the company's internal earnings.
Absolutely.
Well, that is all the time we have for this deep dive. Make sure you follow the show for your daily earnings coverage, and we will catch you next time.